In 1999, Warren Buffett made a bold prediction. He warned that stock market returns over the next 17 years would be far lower than most investors expected. At the time, the market was soaring, and nobody wanted to hear it. People were convinced that tech stocks were the future, that they couldn't lose. But Buffett was right. Less than a year later, the bubble burst. The S&P 500 collapsed, and investors faced years of disappointing returns. Now, history might be repeating itself. Today's stock market is looking eerily similar to what we saw in the late 90s. There's an overwhelming excitement around new technology. This time, it's AI. Stocks are reaching extreme valuations, and investors are pouring money in, afraid of missing out. But as we've seen before, this kind of exuberance doesn't last forever. Buffett avoided the dot-com bubble because he recognized a pattern. He had seen it before in industries like automobiles and aviation sectors that were revolutionary but still wiped out most investors. Back then, Amazon's Jeff Bezos even asked Buffett for a list of car and airplane companies that had failed. The lesson? When an industry is booming, most investors bet on the wrong companies, and when the bubble bursts, only a few survive. During the dot-com crash, even Amazon lost over 90% of its value. Many other internet companies like Pets.com and Webvan completely disappeared. Even major players like Cisco saw their stock price drop by 80%. The warning signs were there, but people ignored them. So, what about today? According to legendary investor Howard Marks, the current market shares many similarities with the one Buffett warned about in 1999. AI stocks led by the so-called Magnificent Seven are skyrocketing, distorting the entire S&P 500. These 7 companies now make up over 30% of the index's total weight. Just 5 years ago, their share was half that. This level of concentration hasn't been seen since 2000s, at the peak of the dot-com bubble. Back then, the top 7 stocks made up 22% of the index. We all know what happened next. Marx explains that market bubbles aren't just about numbers. They're about mindset. He describes 4 key signs of a bubble. Number 1, irrational exuberance, when investors ignore fundamentals and assume stocks will always go up. Number 2, blind adoration, when companies are seen as untouchable, no matter their actual earnings. Number 3, FOMO, fear of missing out, when people feel forced to invest because everyone else is. Number 4, a belief that prices can never be too high, when investors convince themselves that valuations don't matter. Right now, all 4 of these are happening with AI stocks. News outlets claim companies like Nvidia can't lose. Everyday investors are rushing in, trading Tesla, Nvidia, and Bitcoin. Price-to-earnings ratios for some of these stocks are over 50%, showing just how much investors are willing to pay today for uncertain future earnings. This is exactly the mindset Buffett warned about in 1999. Back then, inexperienced investors expected annual returns of 22% for the next decade. The reality? A negative 20% return over that period. Bubbles often form around new industries. Marx points out that we've seen this before. The Nifty 50 stocks in the 1960s, hard disk manufacturers in the 1980s, internet stocks in the 1990s. Subprime mortgage-backed securities in the 2000s, and even further back, there was the tulip mania in the 1600s and the South Sea bubble in the 1700s. The pattern is always the same. When something is new, there's no historical data to keep valuations in check. Investors have nothing to compare it to, so enthusiasm runs wild until reality sets in. Marx compares today's AI hype to the emperor's new clothes. In the story, people pretend to see a beautiful suit that doesn't exist, just to avoid looking foolish. In markets, investors do the same thing. They don't want to admit that valuations might be out of control until it's too late. So, how do you avoid getting caught in a bubble? Marx offers 3 key principles. Number 1, it's not about what you buy, it's about what you pay for it. Number 2, good investing isn't about picking great companies, it's about buying at the right price. Number 3, no asset is so good that it can't become overpriced and dangerous. That last point is crucial. The internet did change the world, but that didn't stop most dot-com stocks from going to zero. Cars revolutionized transportation, but almost every early automaker went bankrupt. AI is likely to be the next big technology, but that doesn't mean today's AI stocks will be long-term winners. Right now, Nvidia is the only AI-related company actually making money from the boom because it sells the hardware that other AI companies need. But software companies aren't seeing AI profits yet, and investors are already pricing in massive future earnings. If those profits don't arrive fast enough, stock prices could crash. So, what should investors do? Buffett made one thing clear in 1999: he never tries to predict short-term market moves. Even though he saw the bubble forming, he didn't sell everything and run. Instead, he focused on one thing: buying companies with durable competitive advantages at reasonable prices. Markets don't always move based on fundamentals in the short term. As Buffett put it, in the short run, the market is a voting machine. It moves based on hype and emotions. But in the long run, it's a weighing machine. Valuations eventually matter. We've seen this play out before. In 1999, stocks soared because investors expected endless growth. When that growth didn't happen, prices collapsed. Today, investors assume Nvidia and Tesla will dominate AI for decades. But history shows that dominant companies don't always stay on top. Only half of the famous Nifty 50 stocks survived. Only 6 of the top 20 companies from 2000s are still in the top 20 today. The lesson? Even great companies can struggle over time. History doesn't repeat itself exactly, but as Mark Twain said, it often rhymes. One of the biggest dangers in markets isn't just high valuations, it's investor patience. When a stock's price skyrockets based on future expectations, it starts a countdown. Investors are willing to wait for earnings to catch up, but only for so long. If the company doesn't deliver fast enough, the stock price adjusts, sometimes violently. Take Nvidia as an example. Right now, investors assume 3 things. 1, Nvidia will dominate the AI industry for decades. 2nd, its profits will continue to grow at an extreme pace. And 3rd, no competitors will disrupt its position. But history suggests that dominance in high-tech industries is anything but permanent. Only 6 of the top 20 companies from the year 2000s are still in the top 20 today. Many former market leaders, from IBM to General Electric, have seen their influence shrink over time. Betting that today's giants will remain dominant forever has rarely been a winning strategy. Howard Marks warns that persistence is hard to achieve, especially in industries where new technologies emerge and disrupt the status quo. The moment investors start questioning whether a company can live up to the hype, the bubble begins to deflate. And with AI stocks priced for perfection, there's very little room for disappointment. If history has taught us anything, it's that markets eventually return to reality. The only question is when and how much damage will be done along the way. So, is a crash coming? Are we looking at another 1999? In many ways, yes. We're seeing the same investor psychology, the same runaway valuations, and the same belief that this time is different. That doesn't mean a crash will happen overnight, but the warning signs are there. The key takeaway? Don't get caught up in the hype. The best investments aren't about picking the most exciting companies, they're about buying quality businesses at the right price. And right now, it's worth asking, are today's AI stocks really worth the price investors are paying? Because if history is any guide, the answer might not be what people want to hear. What do you think about this? Comment below. And if you enjoyed this video, make sure you hit the like button, and also don't forget to subscribe to our channel for more of these kinds of videos. Thanks for watching.